Ladies and gentlemen, hello, and welcome to this afternoon webinar. Apologies for the delay, 3 minutes delay. I just have some serious technical issues here. So, hello, Mr. Paul.
Hello,
thanks for your patience. How are you? Everything is all right?
I'm all good, ready to go.
Yeah, that's perfect. So, ladies and gentlemen, I would just like to welcome you to this webinar that you're gonna learn a lot about price action, especially with Mr. Paul, an exceptional trader in the field. So I would just quickly want to make sure that you are aware about the trading podcast we do every single Monday from the website. You can find, and let me just in a second walk you through that. Where is this? It's here. So you go to our website and you can go to analytics, weekly trading podcast, scroll down, and you can download it from Spotify and all the other available sources. I'm sharing with you very quickly the link so you can be in line with that. And let me go back to the slides. And here we have the mobile application. Please make sure you download it if you haven't so. And without saying more about all this stuff, I will just pass it on to Paul, that it will help you with your trading. Okay, you have so much to learn. Paul, try to share your screen to make sure it's fine.
Absolutely, will do, Theo. We can do that to make sure all our tech is working today.
Okay, perfect. Okay.
Bosh, and there we go. We're in business.
Perfect. Thank you.
Excellent. All right. Well, thank you, Theo. Thank you for the introduction. Apologies for the little bit of tech delay. Happens to us all, doesn't it? And stuff. You know, none of us particularly like it, but it's the nature of the way we live our lives. But anyway, thank you for sticking out. Thank you for hanging on, and welcome to the next session here in Paul's Ultimate Price Action Trading Guide. Session 7 today, and we're going to talk about managing risk. Okay, it's unbelievably important, all right? And I really cannot stress how unbelievably important it is that as a new trader, or in fact any trader, that you are managing risk first and foremost. And I'm going to go through that today. We've got a lot to cover. I'm going to try and get as much as I can to share with you. But you know, hopefully as we go through the session, we'll realize that actually why it is, you know, why it's important and what you need to be doing every single day as a trader to ensure that you are managing risk. You know, for all of you joining us here, it's absolutely fabulous. I appreciate that. Appreciate that we have a broad range of experience of people joining the room. I appreciate there'll be a lot of people who are new to trading and maybe not really fully understanding the importance of managing risk. Hopefully, by the end of this session, you will do. And I also recognize that we have a truly global audience joining us. Okay, so wherever you're joining us from in the world, all right, I hope you're well. I hope you're having a great trading year. I hope that you're able to enjoy the shenanigans that we see going on in markets, okay? And I'm hoping that these sessions just help develop you as a trader and help you become the very best trader that you possibly can be. As always, if you have any questions or comments or thoughts, then by all means, you know, feel free to give them a shout. You can put them in the chat box, or if you're watching this later on the Admirals YouTube channel, be sure to you can put us give us a like, you can give us a comments box, or you know, you can, as I said, you can just basically sort of send us a message with a bit of feedback. I'm always interested to hear about what kind of topics you'd really like to hear yourselves, you know, so that we can make these sessions as helpful and as useful to you as it possibly can. So as you said, here we are, Admirals, a you know, global broker with local support, licensed and regulated across a wide range of regulatory environments, providing competitive spreads for the most popular trading products, allowing you to engage with markets with both MT4 and MT5. If you have any questions about Admirals, get in touch with your account representative. They'll be very happy to help guide you. So what should we talk about? Well, this is all about price action trading, but today, okay, we're going to be talking about risk management. How do we employ it in our trading? Why is it so important? And I'm hoping that I'm going to be able to stress that to you, you know, throughout this particular session. And then if there's time at the end, what we'll do is we'll have a look at the live markets. It's an interesting week. Here we are as we're putting this session out and starting to November. Lots of interesting news coming out, okay, makes it even more important for us to be able to manage risk accordingly when we have such, let's say, volatile market shenanigans ahead of us. So for those of you who don't know me, my name's Paul. I've traded for many, many years, traded for funds, traded for clients, okay. Primarily I like to trade FX indices and commodities. And for my longer term trading, I tend to be a trend trader. My shorter term trading, I tend to be a reversal trader. Now, what I can say with reflection to our session today is that, as I said, I've traded for many, many years. I have traded on, hedge funds. I've traded on trading floors. I've worked with, exceptional traders, who've been operating at tier 1 levels and trading at institutions. I can assure you this, okay, of all the most successful traders I have had the pleasure to work with or trade alongside, every single one of them was good at managing risk, okay? Every single one of them was on top of their game when it came to managing risk. I appreciate that when you're a new trader, it tends to be more exciting to want to sort of look at, trading setups, okay, and where can I get in? But actually, let me assure you, the real experts, okay, the really very, very good traders, they are managing risk, okay, first and foremost, all right? And, I'm going to share some of that with you today, but I just want to stress it right from day one, right from the moment, okay, that effectively, it's a case about managing risk fair and foremost, okay? That's what we're looking. So, as I said, this is our Wednesday afternoon session. It's going to be about ultimate price action totally, okay, and today's going to be the next version of it. What we realized is that it's very easy sometimes for new traders to be a bit intimidated by the amount of knowledge required to be able to analyze markets. However, with a bit of education in these sessions and an understanding of how candlesticks, price action, etc. are formed, it becomes easier for us to analyze and understand markets. So each Wednesday, we're going to be building up, okay, a series of sessions that help you educate and informed how to use price action in your trading. And that will be the main theme. But of course, like anything, you can have a main thrust, but there has to be elements we need to cover. And one of those is, like for today, is managing risk, because that is just important. If you are joining us for the first time and you're still new and you're not really sure what price action trading is, it's just a basic means of market analysis using price movement over time. It's very popular with both retail and institutional traders. And really, as the slide says, you're analyzing the change in prices over time. That's the action, okay, the price action. Typically, we are going to focus on our sessions over the last 3 to 6 months, but we will respect longer time price movements and we will look at shorter time price movements. The reason we're going to focus on 3 to 6 months is that I recognize that the majority of people joining us for our sessions, they are probably not trading full time. They are trading around a day job. They're trading around family commitments. They're trading around other lifestyle commitments they may have. So they're only maybe trading for a little bit of time, okay, each day. So they might be looking at trading like end of day or daily charts, okay. But we will focus on that. But the themes, the concepts, the ideas, what I want you to recognize is that they are time frame and instrument agnostic. Once you're able to read and understand price action, okay, it doesn't really matter what time frame or what instrument you're looking at, they will still be, valid concepts that you can utilize. And that's what we want to share with you here today. So what have we covered so far? Not surprisingly, session 1 was an introduction to price action trading. We've had a look at the engulfing candle, very simple, all right, setup. We had a look at session 3 about how to identify a trend and really wanted to stress how good trends leap off the chart. You don't try and force them. Session 4, we had a look at a nice other simple setup called the star formation, the evening star and the morning star. In session 5, we talked about preparing for opportunity in markets, about what you need to do to get yourself into the best place so that you can make the best trading choices. And in last week, we looked at a very popular trading setup for myself, which is called a key reversal setup. So, and today we're going to talk about managing risk. So what we're going to do is each session, will be a bit different. We'll do a little bit on technicals, looking at charts, looking at setups, but equally I want to add in bits about preparing to be the best trader you can be, managing risk, understanding a trend, because these all go together. And as we go further and deeper into the session, it will become more streamlined into almost like a routine that you're able to follow to make you the best possible price action trader that you can be. And that's my aim for you here. So let's talk about managing risk. And here's a question for you, ladies and gentlemen. Of those of you here today, how many of you would consider yourself good at managing risk? How many of you, if you're honest with yourself, are always managing risk on every trade in every session? By all means, just put your own thoughts into the chat box. There's no judgment from me here. We're all here to learn, ladies and gentlemen. All right, and I can learn from you, and same way I hope you will learn lots from me. But part of it is about recognizing, okay, your own limits of your education. As I said, I recognize there'll be people here who are new to trading, and these sessions are about being able to sort of help you develop, evolve, and become the best trader that you possibly can be. So, it'd be interesting to know what, if any, of your experiences have been about managing risk. This is a very great quote by George Soros. Some people will love him, some people will loathe him. The truth of the matter is he was a very successful trader and hedge fund manager. And this quote has always stuck with me. The secret behind success is to embrace risk, not to avoid it. Okay. It's about embracing risk, not to avoid it. And that's, I think he's absolutely spot on. But what we need to do is to understand, well, how do you do that? What does that mean? It's a nice, easy thing to say, but what we actually need to do is to understand, well, how do you do it? What does that actually mean, Paul? So I would explain it as this, okay? If you're looking at Risk Money Management 101, you are a trader, ladies and gentlemen. That's what you are, okay? It's your job as a trader to actually embrace risk, to take risk, okay? There can be no reward without risk. And this is a topic we will touch on all the way through our session, that kind of the conversation, the relationship between risk and reward. It's therefore your job to manage risk. And as the slide says, the better you become at managing risk, the quicker your progression will be to successful trader, right? I cannot stress that enough. I said that a little bit earlier on. I've been very fortunate to, worked on funds, to trade with excellent traders, to have coached brilliant traders. Every single one of them was good at managing risk. All right, every single one. None of them were sort of, just, playing at it. None of them were just, messing around. They were all exceptionally good at managing risk because they knew how important it was. And I want to stress that to you, okay? Because I'm here, giving up my time, and I want you to be the best traders you possibly can be. I really do. I love seeing traders develop and evolve and become the best versions of the traders they can be. And if you ain't managing risk, ladies and gentlemen, you are not going to get on that journey. Managing risk, and I say this quite harshly, managing risk, how good you are at managing risk will define how long and how successful your trading career is. The better you are at it, the quicker your progression. The worse you are at it, or if you ignore it or just try to avoid it, the more challenges you will have, ladies and gentlemen. I'm here to help. I genuinely am here to help. So Karim says you cannot see my screen. I'm hoping you should be able to. I think everybody else can and stuff. If you're struggling to see my screen, please let me know. But I'm hoping that it might hopefully just be at your end, Karim. You might just want to check on that yourself, but hopefully everybody else can see. So what should we talk about? Well, I'm going to talk a little bit about a definition of risk management. We're going to talk about position sizing, right? How much we risk on each trade. How do we position size? I'm going to talk a lot about some golden rules, okay? Some simple golden rules that you can take away from this session and build into your trading right from day one. I'm going to talk about how to protect ourselves from financial catastrophe, things like protective stop losses, the importance of stop losses, using a stop that makes sense. We'll have a few simple, money management rules to finish, and then we'll do some conclusions. As I said, there's a lot I'm trying to get into here today, and it is important. I recognize that sometimes risk management isn't the most sexy of subjects. Okay, I appreciate, people want to look at charts and find new trades. I get it, but this is the important thing. As I said, this will define how successful you are as a trader. So, be sure to take notes and be sure to stick with us. So when I'm looking at a very simple definition of risk management, it is most simplest. I'm just looking at essentially knowing how much I'm willing to risk on a trade and how much I'm sizes in relation to your overall portfolio and cash position. As a trader, that might be a little bit confusing. That might sort of not necessarily sit comfortably with you. All I can say is stick with us. And what we'll do is I'll explain it as we go and hopefully make it a little bit easier for you to be able to understand. So another good quote from the hedge fund manager, Mr. Soros, is that my principle is to survive first and make money afterwards. Once again, very, very simple comment from Mr. Soros. As I said, you might love him, you might loathe him, but he was a very successful trader and hedge fund manager, and that is right. Survive first, make money afterwards. Not try to do it the afterwards, okay, which is what I find lots of new traders do. So with that in mind, let's have two simple rules. Let's have two simple rules, traders. Your first rule when it comes to risk management is you live to fight another day. All right. So back in my youth and many, many, many years ago when I was in the Air Force, okay, you know, I used to be an air defender, okay, and a bit like this tornado here, you know, that tornado is ended up in the gun sights of its enemy. When it comes to trading, all right, I don't want you ending up in the gun sights of other traders. I want you to be able to live to fight another day. You're a human being. You are going to make mistakes, okay? You're going to make mistakes. You're going to oversize something. You're going to press buy when you should have said sell, okay? You're going to take the wrong type of trade, the wrong type of setup. That is part of being human, okay? That will happen. It happens to everyone. It happens to me. What you have to do is you have to be able to recognize that quickly and so ensure that you can live to fight another day so that when you make a mistake, it steers you rather than sinks you. We start to do that by rule 2, which is whenever you're in a trade, okay, you never, ever find yourself in a trade without an exit plan, okay? You always have an exit plan for your trade. And you know, and that's not that difficult. It's not that hard. Lots of new traders, they like to focus on entries. They love to focus on entries. Where do I get in, Paul? Where do I pull the trigger? What do I do? But actually, the really smart traders are looking at where are my exits, okay? Where am I exit? They never get into a trade without an exit plan. And what does that actually mean? And another trading, ladies and gentlemen, you're going to be wrong, okay? You're going to be wrong at times. It says nothing about you as a human being. It says nothing about your self-worth as a trader. It's just part of the natural ebb and flow of trading. You're involved in markets which are so huge, so dynamic, so fast moving that things will change. Things will change rapidly against you. And when they do, you'll realize that, you know, you were wrong on an idea. That is okay. That is okay, so long as you have followed those first 2 rules. You always live to fight another day. And secondly, okay, you never enter a trade without an exit plan. If you do those things, well, then you start to give yourself the chance to just learn from the experiences and become a better trader day after day after day. So with that much, you know, in mind, what do we do when a trade? How do we risk on a trade? What do we actually do if, you know, if we're only sort of wanting to live to fight another day? How much do we risk on a trade? Now, risk profile is a very personal thing. What you'll find is that there are some traders who are very, very happy and very comfortable with risk and very aggressive with risk. Others, they kind of, you know, a little bit avoidant of risk, okay? They're a little bit, you know, a little bit circumspect about risk. And that is understandable. Okay, part of the thing as a trader is to understand where you sit on that risk profile. And it's a topic we will constantly come up and down and find ourselves. It's one of the things that you will learn yourselves, okay? You know, I can give you ideas, I can give you suggestions, I can give you, you know, education, but understanding your own risk profile is a very personal thing. But as a starting point, okay, as a starting point, because I recognize we have lots of new traders joining us, here's what we're going to do in terms of having our very simple risk management rules. I'm going to keep it very, very simple. And what you're going to realize is that we're never going to risk more than 1% of our trading capital on a single trade. That's it. I'm going to repeat that because it is actually important. We never risk more than 1% of capital on a single trade. Now, we'll dig deeper into that, okay? Because some people will not understand that. People will sort of, be confused by that. I see lots of people risking 20, 30, 40, 50, 60% of capital on a single trade. And then they wonder why their trading career goes a little bit awry, ladies and gentlemen. What we're looking to do is we never risk more than 1% of capital on a single trade. What does that allow us to do? It allows us to achieve rule 1, which is to live to fight another day. All right, live to fight another day. But what does that actually mean? To say that you're just going to risk 1% of capital. And so we're just going to have a little introduction to position sizing, okay? But we'll do more of that in a future session. So let's say that we have a trading account of £10,000, all right? And we've decided that we are only going to risk 1% of our trading account on a trade, okay? We've identified a trade, it looks great, we want to take it, but we're only going to risk 1% of our trading account on a trade. So the question I would put to yourselves is, how much capital risk are we actually going to risk? How much capital are we going to sort of put in play in the market if we're only going to risk 1% of our trading account on a trade? So some people will basically be able to pick that up very quickly, others maybe not. But the reality is relatively simple. If we're going to only risk 1% of our trading account on a trade, we're risking £100. Now, I appreciate your account might be denominated in euros, dollars, Swiss franc, whatever it is your base currency is. Okay, that's it. I'm here in the UK, my trading account is in pounds. So if I'm going to risk 1% of my account on a trade, I'm only risking £100, okay? That does not mean I am risking £100 a point. It means I'm risking £100 for the entire trade. If that trade goes terribly wrong, I will only lost £100, which would be 1%. Now, lots of people might sort of, be a bit squeamish about that. A lot of people might just say that's not enough. That's absolutely fine. Remember, what we want to do here is to make sure that you've got the right rules, the right foundation, the right bedrock in place that allows you to effectively to live to fight another day. As you develop in skills, as you develop in experience and knowledge, what will happen is that your position sizing rules and risk management rules may, change. But we're here today to make sure you're doing the right things right from day one. Okay, if you're doing that, you're fulfilling those first 2 rules. Never, always live to fight another day, and never enter into a trade without an exit plan. So Agbor says, question please, are you risking 1% when having a small capital all through the journey? Good question. Good question, that excellent, thank you for that. My suggestion is, to begin with, is that you just keep it simple, keep it static, risk 1%, all right? At the moment, okay, if you're a new trader, you are trading to learn, okay? You are trading to learn. And so what you're trying to do is to make sure that you're putting in all the right processes, the right routines, the right best practices in your trading business, so that effectively, when you develop and grow, that actually you've got the bedrock of the fundamentals in place. Now, of course, if you're trading a very small account, that might be a bit of a challenge, okay, and you may need to adapt that a little bit. But even if you're trading a small account, you have to maybe expand it a little bit. What I'm suggesting is it shouldn't be really more than sort of 3, 4, 5% if you're trading a very, very small account, all right? And actually what you want to be doing is getting down to that kind of 1% level. That's where you want to be aiming. As I said, as you grow and develop and understand your own risk profile, that might well change. That might well change a great deal. But to start with, what we're looking to do is just make sure we're doing the right things, trade after trade after trade after trade. That is what's important right at this particular part of your trading career. I hope that answers the question there. Another quick example. Once again, we've got a trading account of £10,000. We're only going to risk 1% of our account on a trade. So we're risking £100. Okay, that's what we're doing. But in this case, when we look at a position size, we're going to be trading the euro against the US dollar. We want to be buying it there at kind of about 136. Our stop loss, which we'll come on to, is about 135.80. So now we're looking at how many points of trade risk do we have? Trade risk being a point between where our entry is and between where our stop loss is, which we're going to come on to in a slide or two. Well, our trade risk is we have 20 points. Okay, that's the difference between 130.600 and our stop loss at 135.80. So if our capital risk is £100 and our trade risk is 20 points, how many pounds per point can we trade at? This is where we're getting to this sort of just the very basics of of position sizing. And in this particular case, you could trade that at £5 a point. You've got £100 divided by 20 points of risk. That is actually the size you'd be trading at. And if you traded, okay, £5 a point with your stop loss 20 pips away, if the trade fails, well, then you've only lost £100, which is 1% of your account, okay? That's it. You've lived to fight another day. Yes, you won't be terribly very happy, but as I said, a losing trade is part of just being a trader. It's just part of your business, all right? It's just a business expense like any other business. How you manage that risk is what will actually help you become the best trader you can be. But more of this later. So what I have learned over the years of working with traders and coaching them is actually money management, risk management is actually one of the simpler topics to grasp, right? It isn't actually that hard. So long as you're following those rules, you never live, you always live to fight another day, or never enter a trade without having an exit plan. Only ever sort of, risk a small portion of your account in a trade. Never trade without stop loss. If you do those, you will always live to fight another day. But what I find is it is one of the hardest things for many, many traders to follow. And this always fascinates me. Most traders lose money simply because they have no understanding of, or they place no importance on risk management. Without a sense of money management, most traders simply hold on to losing positions for an extremely long amount of time, but then take profits on winning positions far too prematurely. And I see that all the time. They will hold on to a losing position, hoping it will turn for them, and then just grab at profits on a winning trade, okay? And we will look at that. When we look at the sort of the flip side of the risk to reward parameters in a future session, we're looking at rewards rather than risk. Well, we'll talk a lot about that and how that can actually help and how it can be detrimental. But today, it is about making sure you're just managing risk first and foremost. That is what I need to know that you can do. So, I'm giving lots of golden rules here, but another one of them is effectively protect yourself at all times. And in trading, you do this by the use of a protective stop loss. Trading without a stop loss ignores the potential damage that a market can do to you psychologically, emotionally, and financially. And I appreciate that might sound a little bit harsh, might sound a little bit of a bit intimidating. And if it does, I make no apology, right? Because the reason is that, as I've said, all of the great traders I've worked with, okay, they all are very good at managing risk. It is what has made them the best traders they can be. And I want you to be the best traders you can be. And you achieve that by having at your bedrock really good risk management principles in place, just simple rules that you can follow every trade, every day, every week, every month, every quarter, every year. It becomes almost like automatic habit. That is what you do. That's what we look at. So what do we do with a stop loss? Okay, what does that actually mean? Well, I'm going to show you in a few slides where they are at the moment, but a protective stop loss is about protecting yourself at all times and in every trade. It needs to become a subconscious habit. You never put a trade on, right, without a stop loss being in place. It helps you protect yourself at all times. And if you take a loss on a trade, don't take it personally. As I said, it says nothing about you as a human being, all right? If you have followed those two rules, okay, live to fight another day, right, never enter the trade without, an exit plan, that is just part of your business, right? The markets are so big, so fluid, so dynamic, they can change on a sixpence when a bit of news comes out. It's not about you, okay? So long as you've done your job, all right? A trader's job is to manage risk. Remember what I was saying there right at the start, it's your job, and how good you are managing risk will define how good you are as a trader. Trading without protective stop loss orders is outright exposure to financial self-destruction, which, as I said, might sound a bit harsh, but I make no apology. I want you to be the best traders you can be, and you will not be the best trader you can be unless you are managing risk, ladies and gentlemen. So take it to heart, take it on board, okay, and build this into your plan as to how to operate. So when it comes to stop losses, and you'll hear traders talk about, there are multiple ways, okay, multiple types of stop losses that we can utilize and employ, and you'll find you can read lots of them. There's technical analysis stops, whereas, defining where your stop loss is going to be based upon the chart, and that's what we're going to focus a lot on. Some people will use financial stops based on a certain sort of amount of cash that they that they would risk. Some people will have discretionary stops, just putting them in as and where they feel like it. I don't suggest that you do that, okay? That's generally, you're normally asking for trouble as a new trader. Some might have psychological stops. I've had, traders work with psychological stops, namely where they, they only get out of a trade where they feel a certain amount of pain. Once again, I do not suggest that. Okay, that is not a smart way to be a real trader. Okay, that's not the smartest way. Some people will use volatility stops. What does that mean? Well, I'll show you that using just a simple indicator, just to sort of make sure that they are avoiding most of the volatility in the market for where they place their stops. Some investors will use like a percent stop. So when they buy a stock, they might have a stop loss, let's say 20% away. And if it breaks that, well, then they take themselves out of that position. And ones that I use myself in some of my aggressive intraday trading is actually a time-based stop. So I might have a technical analysis stop, but equally I might have a stop based on time, as in if the trade has not done what I would think it would do within a certain time window, I get ready to call the trade, okay? Because there is also not only financial capital at risk, I have emotional capital at risk, and I like my trades to work out. If they don't, I tend to just want to basically to call them. So I appreciate if you're a new trader, that might not make too much sense, but bear with us, ladies and gentlemen. We've got a couple of slides here we will go through, okay? We'll have a little look at a couple of TA stops, very simple technical analysis stops, all right? And other sessions we'll look at psychological stops in terms of common sense stop losses. That's it's a bigger topic for another day. So, as I said, we can talk about technical analysis stops. What I normally talk about is invariably, you want to put your stop loss where your idea holds no more merit, okay? Where actually your idea, maybe in this case, this is a chart of Google on a weekly and you felt that it was going to go long, when it actually doesn't go long, all right, or it goes the other way, your idea is no longer valid. So if the idea is no longer valid, why would you want to be there? So in this particular case, let's bring up the old drawing tool here. As I said, this is Google. This is a trade from Google and weekly chart. As always, you can see I've got the blue 20, the red 50, the green 200 period moving average. That's what I operate on. And what we had was, you can see that on the weekly chart there was a very strong uptrend, wasn't it? There, very strong uptrend. And then what we had here was effectively, this was a weekly bullish flag pattern here. This is what we saw here, price having rallied up. It basically came back here against us before it broke out again. And my view was to be a buyer when it broke through here, okay, when it it's a standard trading a standard bull flag. But when I'm looking at, I need to, well, where's my stop loss? My stop loss has to go where, okay, the idea is not right, but the idea doesn't work. And in particular, if we're buying here, well, invariably my first kind of, worry point was, here, if price had traded down here, then invariably, I was kind of I would have been getting worried. And secondly here, my main stop loss was down here because beneath, okay, the low of the flag, simply because if it's not just doing that there, if it's not working there, okay, if the trade has basically triggered in and then gone all the way down, well, then my idea is no longer valid. And why would I want to be in that trade? So, you can use technical analysis stop losses to basically to look at where, where can I get in, but where are the exits? Where is the level where my idea is no longer valid? Where it is that I don't want to be in this trade anymore? That is where you can start to put your stop losses. That's what helps you, prevents you from having, catastrophic disaster, okay? And I see lots of traders who just don't put in stop losses. They think the trade is just going to, the trade is going to go to the moon. And in this case, Google did fire up. But as I said, it could have easily triggered, turned around and gone all the way down. Okay, that can happen. And it's important that you are basically managing that. Remember, ladies and gentlemen, remember that main thing is that you're always looking to live to fight another day, and making sure that you only risk a small portion of your account and that you're always trading the stop loss ensures that you always live to fight another day. So I don't know if I've had a little bit of a tech fault myself there and stuff now. So let's just freeze there 1 second. Here we go. Back in the room there. Clearly, there we go. Okay, so hopefully you can still all see and hear me. This is another type of just technical protective stop loss here. This was on silver on the weekly chart, all right? And all I'm here is using a trend line as your stop, okay? In this particular case was, we had silver was in a downtrend, okay? It was just basically waving its way down there, okay? Just in a, in a downtrend until it hit this double bottom. okay, and then it put in this lower high. But what we can see was that there was this stop loss here, okay, there was trend line here. My apologies. And the thing is, if you were shorting silver, well, then invariably a good place to put your stop loss was above this trend line. All right, it was above this trend line. Why? Well, because every time price came up, it dropped away. Once we seen it break it here, that was telling us that basically the short trend, that was over. Okay, that short trend was over. If you were still short silver, the world had changed. You're on the wrong side of the market. And with a bit of experience, you'd have recognized here was a double bottom as a reversal pattern. And then here is basically a higher low. So we knew that it was coming to an end. And once it broke here and kept above that trend line, that if you were short in this trade, the trend had changed. You don't want to be in it, remember. So, you can use a trend line. It's just very simple trend line, and have your stop and maneuver it there, okay, until basically until your trade is taken out. Remember, it's about thinking, where do I no longer want to be in this trade? Where does my trade idea fail? I said that some traders will use volatility stops. Okay, now volatility based upon the kind of the amount of movement you might get in a particular period. Could be a 5-minute chart, could be a monthly chart. Okay, one of the things that's very simple to use, especially for intraday traders, is a little tool called the ATR, the average true range. And what that is doing is giving you an indication of the volatility, okay, in that particular instrument on that time frame. So this is a chart of the Canadian dollar against the Swiss franc. It's the 30-minute chart, okay. I was looking to go short here, okay, on the CAD against the Swiss franc. And what I wanted to do is to use the ATR indicator for my stop loss. So at that particular time, okay, just, the ATR is available there on both the MT4 and MT5 platforms. I've just got a period session there of 26, but it can be anywhere between 10 to 26. But what it was telling me was that in that particular case, on that 30-minute chart, the average true range, okay, in that 30-minute chart was about 9 pips, all right? So what I have done is I have basically used 2 times the average true range for my initial stop loss. So where my entry is, what I'm doing is, well, my stop loss is going 18 pips away, 2 times what the ATR is for that particular time frame. Because what I'm expecting is that, if the price does wiggle about, the likelihood is that it's not going to sort of slam straight up and take me out straight away. It could do, but the probability of it happening is much less. So just using a simple ATR, some people will use like 1.5 the ATR. Some people will use 2 times the ATR as a very simple, almost mathematical, almost kind of systemic way of just basically ensuring that they have stop loss in place that is outside the kind of volatility that you might be seeing. Now, of course, 9 pips there on a 30-minute chart is a lot of that will depend upon the instrument you're trading and the time frame. Some of them will be much bigger, some of them will be much smaller. You just have to recognize and take that into account. But the ATR is a very simple tool to use, okay, and especially those people who may want to sort of create algos or basically system trades. Using the ATR can be a very simple way to ensure that you are utilizing stops and keeping yourself outside the remit of the major volatility. And then others, this is just literally using significant big round numbers. Okay, so this is Brent weekly, okay, the kind of UK oil contract weekly chart. And this is just about using a significant number for a stop loss, all right? And in this case, it's a big round number of $50 as the stop loss, because we know that there's always been reaction to it. Once again, it is valid, okay, but it wouldn't necessarily be the smartest way to look at if you're trading on a weekly chart. But as you go down the timeframes, you will find that their big round numbers do become very important. You will see that how markets react to them. And if you're able to identify them on your charts, well, then it can be a very simple way to have a protective stop loss. We know that effectively, for this, in this particular case, there's a variable, it's been, in big trends, they're above it. But you would know that as soon as it got beneath 50, all right, well, invariably, that kind of any bullish sentiment is well and truly over, and you'd effectively, good price action, trading would have recognized that anyway. But it is about, you can utilize a big off, I don't want to be in this trade anymore. Okay, my trade idea has failed. That's fine. But what I want to do now is I want to basically reduce my loss so that I'm able to live to fight another day. That's what we always want to be doing as a new trader. We want to live to fight another day. That's where we aim at. And also what you can utilize here is also another simple indicator off the MetaTrader platform. This is called PSAR, okay, parabolic support and resistance. And you can just select that and put that in. This is Tesla on a 4-hour chart. And you might hopefully be able to see is that what it does is it collects, dots above and below price. When price is in an uptrend, you can see that basically it just effectively plints a dot there, okay? And what you can do is you can just utilize that as a place where to put your stop loss, and you maneuver it as it goes and until it flips and you're taken out. And that, once again, is quite a simple, quite systemic way to basically manage your stop loss. Make sure you've always got one. It's not perfect. Nothing is in trading. Nothing is. What is actually perfect is you having something that you can just follow simply trade after trade after trade. So if you struggle sort of identifying position sizing, if you struggle, okay, to make sure you get a stop loss, utilizing something like PSAR, okay, an indicator can be helpful because it's just consistent. Every time you have a trade, you just put it on and you just follow it. And that in itself can help you. Remember what we're looking to do here. Rule 1, we want to live to fight another day. And the way you do that is by ensuring you only risk a small portion of your account or trade and that you never trade without a stop loss. You do those two things, you will always live to fight another day. And if you live to fight another day, you learn from your trading experience. And if you learn from your trading experience, you get better day after day, week after week, month after month. And that's what we're looking to try and do. So check out PSAR. That might actually help you a great deal. So to finish, we've got to understand about preparing our trade in terms of risk management, and we can do that quite simply. Is that when we've identified our trade, we want to effectively identify our trade risk. Where are we getting in? Where are we getting out for wrong? This was a trade from a few years back. Price had pulled back here, and then what I had was here at my 200 period moving average, I had 3 pin bars. Join me next week. I'm going to talk about trading pin bars. I had 3 pin bars, and so I figured that price would bounce, okay, off here. And so I wanted, as price wanted it, I wanted to keep long as price basically broke out of that. But what's my next thing is, I need to work. Where am I wrong? Okay, where is my exit plan? My exit plan, my stop loss, was beneath the lows of those pin bars, because if price triggers and falls away, my idea is wrong. I don't want to be in that trade anymore, okay? So that's what I've done. I'm identifying my entry, okay? This is where I'm getting in long, and I'm identifying where my exit price is if I'm wrong. There we go. I've started to do that. That is helping me now to identify my trade risk, okay, in price. Now what I want to do is to identify, well, what are my potential rewards, okay? Where am I take profit? If I know where my stop loss is going to be, if I know where I'm getting out when I'm wrong, I want to know, well, where do I get out if I'm fortunate to be right? In this particular case, there was a big round number here, a big resistance level here, and that was my target just in front of that, which was going to give me a handsome, reward to risk. And that's me just looking at my price versus my exit price target. You're right, okay? So suddenly I've started to know if I'm wrong. I know if I'm getting out, if I'm right, off into place. I'm calculating my risk to reward, okay? I always want asymmetric reward to risk, okay? If I'm going to risk £100, I want to be able to make 150, 250, £400, okay? And I always want to make sure that, I've got a good, as I said, a good asymmetric reward to risk. That's what I'm always looking at. And then really what I'm looking to do is that, I've identified my trade risk, my entry versus my stop loss. I know what my capital risk is because it's always going to be 1% of my account. And if I'm dividing my, my trade risk by my capital risk, well, then I will know what my position size is. And if I'm doing that, well, then invariably I'm ensuring that, I'm only risking a small portion of my account on the trade and that I'm never trading without a stop loss. So I'm fulfilling that first rule. Always live to fight another day, ladies and gentlemen, okay? Trading is not about you being a hero. It is not about you putting it all on one trade. It is about, living to fight another day. Rule 1, live to fight another day. Get better as a trader every single day. And that's, that's what will help take you the furthest in your trading career. So I appreciate position sizing. Okay, there's a lot more to it, but you are very, very helped these days. Okay, in terms of understanding position size, it can sometimes be challenging to do it together yourself when you're using FX pairs. There is help. There are external tools like my FX book, which has a position sizing calculator, which also on the Admirals website. There's limit your losses and let your profits run. All right, there's like two of the oldest sort of kind of comments about trading, about cut your losses and ride your winners. Percent of your account. Keep it simple. Know your risk to reward ratios. We want asymmetric reward to risk ratios. We'll touch that in a future session. Capitalized, okay, for your goals. All right, I find lots of people have very. You never ever trade without a stop loss. All right, you never ever trade without a protective stop loss. You never add to losing positions, okay, as a beginning trader. All right, okay. You never move your stop against you, all right? And what I mean by that is that sometimes, people put a trade on and they think it's going to go against them, so they will remove the stop or move the stop even further away, okay, to give the trade room to breathe. Never, all right? Never. The trade is on, all right? The trade is on. You know where you're getting in. You know where you're getting out when you're wrong. You know where you're getting out when you're right, okay? Put the trade on. Let the trade play out. Learn from your trading mistakes, ladies and gentlemen. Keeping a trading journal will help you enormously. Remember what I said, live to fight another day. And always have a maximum loss or retracement in profits. If you've had a few losing trades, okay, or if you've lost a certain position you count, just stop, take a bit of time, reflect on it, work out what's going on. Is it you? Is it the market? Is it your system? Okay, take a bit of time. Okay, just to take the time to manage your business. This is your trading business. So, in conclusion, ladies and gentlemen, as I said, money management is one of the simpler topics to grasp, I think, in trading. That seems to be very hard for many, many traders to follow. And if you can follow it, it will help make you the best trader you can be. You can overcome a lot of bad luck with proper money management techniques. You really can, ladies and gentlemen. What that does is it allows you to get that journey is going to be longer than you want it to be. Okay, manage risk really well, because that is the thing that will help you speed up your journey the fastest. All right, you never risk more than 1% on any trade, and you never ever trade without stop loss. If you do those two things, you will always, you've got a good review process. You're reviewing your trades, looking where did I make mistakes, where could I have done that better. You will get better and better and better as a trader. I assure you of that. Okay, and that's what we're looking for. So, as we draw to a close there, ladies and gentlemen, just remember that, next session in Paul's Ultimate Price Action Trading Guide is going to be next Wednesday, 9th of November, 2 o'clock London time. We're going to talk about pin bars. Okay, so every week we'll do a little bit on trading stuff like risk management, and then we'll do little bits on setups and looking at charts. Next week is all about setups and charts. So what is the pin bar? How do traders identify and trade them? What are the best setups? I'll be sharing some of my own sort of ideas on that. As I said, that's 2 o'clock London time, 9th of November. Check your inbox for the webinar link, or go onto the website, okay, and sign up for it. And that'll be a good session to join us there. As always, if you want to contact Admirals, you can do. They've got the links there, okay, to be able to work with them there. So there we go, ladies and gentlemen. Unfortunately, because we're a little bit late with the tech start, we don't really have time to look at the charts today. I apologize for that. But what is important is that I wanted to focus on making sure that you get an idea of managing risk, and also for me to stress how important it is. As I said, I've worked for funds, okay, I've traded alongside great traders, I coach great traders. All of them are managing risk. All of them are managing risk, and it is like built into them. It's their natural default. Okay, they don't have to even think about managing risk. They are doing it day in, day out, every trade, every session, every day, every week, every month, every quarter, every year. That is what makes them the really good traders, because they've got that bedrock in place that basically helps them become the best trader they can be. So, please take on board that. All right. You always want to live to fight another day. And if you trade, a small portion of your account on each trade, and you never trade without stop loss, you will ensure that you will always live to fight another day and become the best trader that you can be. And that's what I want for you here, is, just as an individual, one from one trader to another, but also here from Admirals as well. So it just ends for me to sort of end on the fact that I wish you the very best of success in your own trading. Okay, thank you for joining us. I hope you found it useful. All right, make sure that you sign up for our next session next Wednesday. Then look at pin bars. Always fascinating, always great stuff to look at there. I hope you have a great trading week, everybody, and I will speak to you soon. Take care, everybody. Trade well.